Good morning, everyone, and thank you for joining us for Cherry Bekaert's 2022 Government and Public Sector two-day virtual conference. My name is Christian Philgraff, and I lead Cherry Bekaert's Government and Public Sector Group. At Cherry Bekaert, we find events like this to be very important, and we believe in giving back to our clients. This is part of our client service. When I was in government, I found events like this to be very, very useful for both myself and for my team. So it's a pleasure for us to be able to do this, and hope we have a couple really good days, interesting speakers with a great opportunity for our clients and friends in government to hear about some best practices and interact with one another while learning and learning some new ideas and some things that are going on that can help both your government organization as well as our citizens. We have great presentations planned. We'll be offering up to 1 hour of CPs per session. Today's agenda is comprised of 4 sessions ranging from a GASB update to managing federal dollars, fraud protection, and an APA update. On Thursday, we're going to gather again for the second day of our virtual conference to discuss current cybersecurity trends with best practices to mitigate risk, along with an overview of dashboards and analytics, something that everybody's really interested in. It's important to all of us right now. And then round out the conference with North Carolina specific state auditor update. Each session will be led by professionals who will share tools, tips, and techniques regarding these topics. We hope you're able to join both days and all 7 sessions. So here's some items to note before we get started today. To receive CP credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CP sessions or certificates will be issued via email within 10 days. If you have not received your certificate within 10 days or after 10 days, please email us at cbhlearning@cbh.com, and we'll make sure you get it right away. A recorded version of this webinar will also be available about 1 week after they complete, and we sent via email and posted on our website. If you have any questions during the webinar, please type them into the Q&A window located on the control panel, and we will be answering those as we go or following up with you depending on which session it is. Just note, a short survey will also be posted at the conclusion of the webinar. We really do value your feedback and ask that you take part in this. We do this annually, and our goal is to make it better and better year after year. And with that, I'd like to introduce the first speaker, Scott Anderson, who's Director of Assurance Services with Cherry Bekaert. He'll be providing an overview of accounting and reporting requirements of the recently issued GASB Standards and the likely impact of GASB's current projects that are anticipated to become the new standard in future years. Scott just returned to Cherry Bekaert after a 2-year fellowship at GASB. So his insight and his thoughts are going to be really be valuable for all of us today. With that, Scott, take it away.
Well, thank you, Christian, for that introduction. It is great to be here and great to be back with the firm. This is actually my 6th day back with the firm, started back up last Monday. So I'm glad to be here. I saw the names on the registration list. I see a lot of familiar names. So I'm excited to be back and serving all of our clients and being available for all of you. We're going to start off with a polling question. Now, this is not a polling question specific to this GASB update. Think of it as a question for the conference altogether. But what is your primary purpose for attending today's webinar? A, interesting topic. B, knowledgeable presenters. C, just the CP credit. Or D, other. And I will tell you, as you are submitting your answers to this question, this is only a 50-minute GASB update, which is pretty short as far as GASB updates are concerned. And so I did cut a few things out that I probably normally would cover. I'm going to focus today on the exposure draft that's out there now, as well as the 3 pronouncements that were issued in the last couple of months. And so I won't talk a lot about actual projects that are going on. The big comprehensive projects, revenue and expense recognition and financial reporting framework is still ongoing. Those will still be ongoing for a few years. And then there's a new project for going concern and non-financial assets, and those are still happening, but we're not going to talk too much about those today in this update. So we have some results from the poll. If you can see those, it looks like the top answer was for the CPE credit. I certainly understand that. Actually, I get CPE credits. It's quite interesting working at the GASB. I can develop an accounting standard without getting any credit, but then I would get credit by listening to someone talk about it, and that made a lot of sense. And then interesting topic is the second, followed by knowledgeable presenters and others. And so with that, I will go ahead and close out. Has that been enough time?
Yes, we're good to move.
Okay.
Thanks,
So
Scott.
one of the questions and one of the requests that I received was to share a little bit about what I learned at GASB first, and I'll try to move quickly. I've gotten this question a lot, and I've been thinking about this over the last month or so as I've made this transition. And as I was thinking about this, I was driving down the road and I was coming to a stoplight that was malfunctioning. And you've seen this before. I was seeing a blinking yellow light, which told me I was to proceed through with caution. And the cross street was getting a blinking red light, which told them obviously to treat it like a stop sign. And it was a busy intersection. And then as I was getting to the intersection, I could see that everybody was treating it like a four-way stop. Everyone was stopping when they got to the intersection and waiting their turn and then moving. And as I was thinking about that, I thought, well, the rule says that I don't have to stop. I have the right of way. I should just be able to move through. But because everybody else is treating it like a four-way stop, I should probably treat it like a four-way stop. And that's what I was prepared to do. And then the car in front of me, it's like had the same debate and made the different conclusion. And instead of stopping, just went right on through the intersection. And as you might imagine, there were screeching tires, blaring horns, and we were mere inches away from witnessing an accident. And I had wondered, and I saw that, and I wondered who would have been to blame, right? Well, whose fault would that have been? The person who was following the law, or the person who was doing what everybody else was doing? And I instantly saw this parallel with GASB Standards, because I had this topic on my mind. GASB produces accounting principles, but they aren't relevant unless they are generally accepted. If everybody did what they wanted to, GASB would have no authority and it wouldn't mean anything. And GASB understands that GASB functions with that understanding. And over the years, I've heard a few people refer to the GASB as if it's some sort of adversarial relationship between the board and its stakeholders, or I've heard sometimes it referred to as the ivory tower on the board that just hands down pronouncements, irrespective of what anybody else thinks. And having been up there, I can tell you that is further, could not be further from the truth. Nobody over there thinks of themselves as being an ivory tower. And in order to ensure that these standards are generally accepted, the due process procedures are extensive. They do everything they can to make sure that stakeholders have a chance to engage and to express their opinion. And I have seen board members change their mind based off of feedback received from stakeholders. And so that was one insight that I don't think I realized before going in, is really how important the due process is as far as GASB is concerned. The second thing I noted or came away with was how difficult it is to set accounting standards. It requires a lot of collaboration. It requires a lot of creativity. There's a lot of problems that have to be solved. And when I walked in the door, the first thing David Bean told me was, there's no right or wrong answer. There's just a best answer. And so our job is to try to come up with that best answer. And I've seen very smart people have a different idea of what the best answers are. And so it is a very interesting and collaborative process. And I was quite impressed with the GASB staff there and the level of creativity that they possess in devising these standards that work. And then the last thing I'll mention before moving on is the GASB staff are eager to help. If you aren't aware, there is a technical hotline or technical form that if you have a question, they want you to ask those questions. Not only does it help them gauge where folks are with implementations, it also gives them an idea of other things out there that for which there isn't enough GASB literature to assist. So very important. They treat that hotline as if you guys are paying customers. They track how long it takes to respond. There's a 24-hour rule for first responses, and usually within a week, the whole inquiry is closed. So anyway, those are three brief things that I came away with from my time at GASB. So after talking about the importance of engagement and pouring my soul out to you about all that, I thought it'd be best to roll into this exposure draft that was released in June on certain risk disclosures. This exposure draft is particularly important because it is a project that the board did not unanimously agree on the provisions of what's in there. You'll notice there's an alternative view. The board agreed with the objective, which is to provide an early warning to financial statement users. The board agreed on what would be essential to be disclosed, but where there was some disagreement was what types of requirements or what requirements needed to be in the proposal in order to arrive at this essentiality for users. And so that's why it's important. And I'll also note that there is a new way for you to provide your feedback on this. No longer do you have to write a traditional comment letter, which could take a lot of time and resources. There is an electronic feedback form, a link on the second page. And if you click that, it takes you to a survey and it asks you questions, and you can provide the board feedback in that way. And it's a little less formal and a little bit easier. And in particular, it's to help users, give them an avenue to provide the feedback. If you are familiar with FASB standards, you might think of this as the GASB's version of Topic 275. The board was putting together Statement 62. When they were putting that together, they had contemplated whether to codify the guidance that became Topic 275 in the GASB literature. And at that time, the board decided to hold off on it, believing it would be better to take more time to gather feedback from stakeholders and assess the issues in light of the government environment. So as we go through this, you might see some similarities with Topic 275, but you'll also see a lot of differences as well. So I want to start by describing the concept at a very high level. The exposure draft begins by identifying specific risk categories or conditions on which to focus. If a condition as described in the proposal exists, then a government would need to identify an event that, if it were to occur, would have an adverse effect on the government's ability to provide services. So let me give you an extreme example. A small town has a taxpayer that represents 80% of its tax base. Nothing magical about the 80%. I'm just trying to be extreme with my example. The town manager becomes aware that that taxpayer, which is a company, is experiencing severe financial challenges and has determined that there is a possibility that it will go bankrupt and go out of business. And if the town loses 80% of its revenue, it will not be able to provide the same level of services or pay off its outstanding bond obligations. So the general idea here is the condition, as described in the guidance, plus an event produces an effect. The conditions that are described in the exposure draft, and by the way, the word condition is not anywhere in the guidance, but we're referring to it simply here just as condition, are limited to two broad categories. And it is described as something that limits a government's ability to acquire resources or control spending. So the first condition is concentrations, which is one that is included in FASB's Topic 275. A concentration is a lack of sufficient diversity related to an aspect of a significant revenue source or expense. And here we have some examples. I talked about the principal taxpayer or resource provider already. You can also have a principal employer, perhaps a firm that employs a large percentage of the population. You can have a principal industry. Think of a coastal town that is heavily reliant on tourism, for example. You can have a concentration in the composition of your revenue. For example, all property tax as opposed to a variety of imposed and derived taxes. You could have all of your workforce unionized, which would limit your ability to control staffing levels or pay rates. And you could also be reliant on a particular supplier or for materials and services. So remember from the previous slide, having a concentration does not automatically trigger a disclosure. The board wants to avoid boilerplate disclosures. So it would need to be accompanied by a looming event that would exacerbate that condition. Then the second condition is a constraint. This is one that you will not find in topic 275, although it originated from asking users about FASB's requirement to disclose the nature of operations. Disclosing the nature of the operation for a government would not be helpful. Anyone reading the financial statements would already know what the purpose of the government is. But based on some feedback from users, it was determined that perhaps certain constraints would be useful to know about. So here we have some examples. Caps on raising property taxes, for example. Debt ceilings would be a constraint. Unfunded mandates would be a constraint, etc. The board also considered looking at estimates in the preparation of financial statements, which is one that's mentioned in 275. Users resoundingly said that that's not helpful information for them, and so it was excluded. So understanding that we have a condition coupled with an event that produces an effect on the government, the board undertook to apply some limitations so that governments aren't disclosing everything that could possibly apply to that model. Because after all, we want the information to be essential, and we want the disclosures to serve as an early warning that something bad might happen. And if you included every possible thing that could happen, then it would not be essential and would make disclosures far too long. So in total, there are 5 limitations that fall within these 3 categories. And the first category is likelihood. So if a condition exists, the board believes you should only be considering events that are more likely than not to occur. Now, this is where we start to see some divergence in the board's opinion. 5 out of 7 board members believe this and voted for this provision. The other board members believe that the threshold should be lower, preferring the threshold of reasonably possible, and I'll illustrate that difference in a second. The second likelihood is with regard to the effect. It's possible you could have a condition and an event, but then the effect is, somewhat underwhelming. So the board believes that a government should also evaluate the likelihood that there will be an effect, and that likelihood for the effect would be at least reasonably possible. So I put together this next slide to demonstrate the thresholds that the board considered when they were developing this exposure draft. All of these thresholds are those that are already mentioned, already defined, at least somewhat in existing GASB literature. You can see that the at least reasonably possible covers a lot of ground. A lot of events may fall into that threshold. The board members who wanted more likely than not instead prefer it because they believe it will screen out a lot of events that really will never happen, as well as the fact that more likely than not is a little bit more precise of a threshold, defined in statement 70 as more than 50%, whereas at least reasonably possible is defined in statement 10 as more than remote but less than likely. So it's a little bit less defined. The board members who are in favor of at least reasonably possible believe that the other limits would sufficiently limit the number of disclosures, and that the more likely than not threshold would produce too few disclosures or disclosures about events that are not early enough to be an effective warning. The next limit that the board placed on these disclosures is with regard to timing. The event must be somewhat close to occurring. I'm sure you can think of an event that could happen years from now, but in order for it to be useful, the event needs to be expected to occur within the next 12 months. You'll note that the language here is similar to that used in statement 56 for foregoing concern considerations. And then the second timing limitation is the timing of the effect. The board decided that there needed to be a longer time horizon for the effect because it could take a while for the effect to be felt. Think about the loss of a taxpayer. You might not feel that effect until the next year's tax assessment and then the collection period and so forth. So the board decided 3 years was about right for the effect to occur without being too speculative. And then the last limitation is with regard to magnitude of the effect. It isn't enough that there is an effect, but it must be a substantial effect in order for it to be worth mentioning for users. So substantial is intended to be a very high bar, but it is not a term that the board felt comfortable defining. The basis for conclusion alludes to it being a higher threshold than that of materiality. One might take a look at the term of severe impact in topic 275 and draw a similar conclusion about what substantial effect is intended to mean. The board did not originally want to prescribe any disclosure requirements. In fact, initially the board didn't want to specify any disclosure requirements and only required that these risks be disclosed. However, it became clear that this would not result in enough essential information. And so the board reluctantly provided some disclosure requirements, and I've summarized those here. The fear, again, is that we will get boilerplate disclosures. And so an objective was included that a preparer or government should disclose enough information to provide users an understanding with the risks that they're facing. All right, so with that, I will go to the next polling question. Do you plan to provide the GASB with feedback on this exposure draft? And again, there are two different ways to do it. You could provide a comment letter, which is traditionally what we've seen. You can put in an electronic input form. When I was just leaving, we had just issued the statement and I was almost out the door. And as soon as this went out the door, we almost immediately started receiving some electronic input form. So that might be an effective way to get some feedback. So far, a lot of people say no, about 58%. We've got 36% saying I don't know, 5% saying yes to the electronic feedback form, and 1% or 6 respondents to yes for a comment letter. If you guys are curious, most projects get about 30 to 40 comment letters. Statement 99, which was one I worked on, received about 18. And so I think the board would prefer more feedback than that. And when feedback is very essential, such as with the comprehensive projects, then we do public hearings and user forums and all that stuff just to get that feedback. All right, so I think that's been a minute. We're going to go ahead and move on. The next statement is, or the next topic is the statement that was issued back in April, the Omnibus. The Omnibus is like any statement, any Omnibus that's issued, I think it's one that's easily overlooked. This is one that I worked on quite a bit, represents 18 months of my life. And so when it was issued in April and then immediately statement 100 and 101 was issued after that, I thought, oh, well, no one's going to read this statement. So I want to talk a little bit about it, and I won't cover it in too much detail because it does cover a lot of topics. The purpose of the Omnibus, of course, is to address certain practice issues that have come up. And I'll tell you, I walked in the door and the first thing Dave Bean did was give me a list of things that they've been tracking that needed to be fixed. And that's how this Omnibus came about. And so none of these issues are substantial enough to warrant or justify its own project. And so we just kind of put it all together. And I will say, from having assisted in putting this together, I understand the omnibuses are really hard to read. They're hard to understand what's really happening because all they are doing is amending other guidance, and it's not written in a way to make it easy to know what's being changed. And that's just because of the format that a standard section has to be in. You can't say just replace this word with that word in the codification. It doesn't work that way. Instead, the advice that I would give is with the omnibus statement, the codification instructions become quite important. And that's where you're going to see what words would be replaced. And I'll give you an example. One of these technical updates, and I'll advance the slide now. These are the topics that this is covered, but one of these technical updates or corrections is with regard to non-monetary transactions in Statement 62. The guidance there requires a government who engages or has a non-monetary transaction to disclose the basis of accounting for that transaction, which doesn't make a lot of sense, that term, as it's defined in the concept statement. And what's really intended is for a government to disclose the measurement attributes related to that transaction. And in fact, if you go and look at some of the practice aids that are out there, I think everyone just understood measurement attributes and have been disclosing measurement attributes, but the codification reflected that incorrect term. And so we made that change in the statement. But if you read the paragraph, I think it's paragraph 30 something, you don't really get that until you go to the codification instructions, and you'll see where it says remove basis of accounting and replace with measurement attributes. So that's a little bit of insight when it comes to reading these omnibus statements. They are important. They do make some changes, but sometimes they get a little bit lost in the shuffle. So these are the topics that that are covered. And again, I'm going to go through these fairly quickly. Financial guarantees, other derivative instruments. There were some amendments to leases, P3s, and SPIDAs. That is statements 87, 94, 96. And then an amendment to statement 93, which amended 53. So really an amendment to 53 with regard to the use of LIBOR. We'll start with financial guarantees. And as I said, I'll try to be brief about this. Statement or financial guarantees originally was provided for in statement 62 under the contingency guidance or the contingency literature. And it required that a government who extended a financial guarantee should recognize or accrue indemnification payments if it becomes probable that they'll have to make those payments. And about 10 years ago or 10 or 15 years ago, the problem became that governments who were extending these guarantees were not actually recognizing these payments until they were actually making those payments. That term probable is a difficult one because there are so many interpretations as to what that means. And some think probable is anything above 50%, and some believe it's a threshold closer to 90%. And so financial guarantees just were not being accrued the way they were supposed to. And so the board undertook a project that turned into statement 70. That project or that statement changed that threshold for non-financial guarantees or non-exchange financial guarantees to more likely than not, rather than probable. In that statement, the board specifically carved out non-exchange financial guarantees because those were the more prevalent in practice. And at the time, to be frank, the board didn't want to touch the revenue recognition component of an exchange financial guarantee. And so they only addressed non-exchange financial guarantees. Fast forward 10, 15 years, and what we had started to see is governments who extend financial guarantees were starting to charge a nominal fee just so they can apply statement 62 instead of statement 70 because of the perceived favorable threshold of probable over more likely than not. And so all we're trying to do here is apply the guidance of statement 70 to the exchange or exchange-like financial guarantees, giving it the same threshold of more likely than not. There were a few other changes made by statement 70 from 62, such as the way the liability is measured, as well as a few additional disclosures. And so the omnibus captures all of that and applies it to all guarantees. The next topic is with regard to other derivative instruments. Derivative instruments, of course, are addressed in statement 53. And the way statement 53 is written, all derivative instruments within its scope were categorized into two categories: hedging derivative instruments or investment derivative instruments. And the way investment derivative instruments was defined was a derivative instrument that is primarily held for the purpose of income or profit, or that does not meet the definition of a hedging derivative instrument. And so in that way, the board ensured that all derivative instruments would fall into one of those two categories. When Statement 72 was issued, the term investment was given a new definition, and Statement 53 was revised to define investment derivative instruments with that same definition. So an investment derivative instrument is now defined as held primarily for the purpose of income or profit and has a present service capacity based solely on its ability to generate cash or to be sold to generate cash. And so in that way, that catch-all, that all derivative instruments that were not that do not meet the definition of a hedging derivative instrument was removed. And that was intentional to make it more conceptually pure. But then the question arose, well, what do you do with derivative instruments that are neither hedging derivative instruments or investment derivative instruments? Another thing that Statement 72 did was made it so that you couldn't categorize something as something and then later change it to an investment or vice versa. It also emphasized that something is an investment based on the intent of acquiring it. And so when you obtain a derivative instrument for the purpose of hedging an identified risk, and then later it falls out of effectiveness, it can no longer be a hedging derivative instrument, where would it go? And investment derivative instrument would not be the conceptually right answer because it wouldn't meet the definition of an investment. So they'll say all of that to say that the Omnibus adds a third category called other derivative instruments. We tried really hard to come up with a different name, but we wanted it to catch every other situation that wasn't a hedge or an investment. And so other is where we landed. A derivative instrument that does not meet the definition of an investment or hedging derivative instrument. And I'll say we were uncomfortable, some of the board members were uncomfortable with defining something by what it is not. But this is the only way to make sure that all situations, even those that are not currently contemplated, are going to be captured in these three categories. The change that this really affects in financial statements is that when a derivative instrument is no longer effective and it is being reclassified out of hedging derivative instruments, you would no longer reflect that within the investment revenue classification. It would either stand on its own if it's significant enough, or it would be included with another category. And then in the footnote disclosures, it would also be separated out. And one of the advantages of this is that it is a little bit more transparent with regard to a government's derivative instrument program. If a government continues to enter into derivative instruments for the purpose of hedging, and they are constantly being shown ineffective, there's more light shown on that with this guidance. And I know I'm moving pretty quickly. I apologize. I want to get to the other two statements, but these are the subtopics related to Statement 87, 94, and 96 that are addressed in the Omnibus. A lot of these are just to shore up the consistency between those three standards. Those are referred to as kind of a suite of standards because leases was developed, and then Statement 94 P3s was developed in such a way to be consistent with Statement 87. And then Statement 96 on speed is the exact same way. And so I won't go through all these in detail. I will say if you have a derivative instrument with a, I'm sorry, not a derivative instrument. If you have a lease with a purchase option, 87 explicitly says that a purchase option is not the same as a option to terminate. You need to go back and look at that because this does make a change there. There were some unintended consequences with that provision that is being fixed with this omnibus. And additionally, I'll also mention the short-term lease exception. If a short-term lease is modified, it can be reclassified out of short-term if the term is extended beyond the 12 months. The other thing I'll mention with the omnibus is with regard to the extended use of LIBOR. Statement 93 was issued a couple of years ago to help governments who had derivative instruments to not have to cancel or terminate hedge accounting because of the demise of LIBOR. One of the provisions in Statement 93 was for LIBOR, that LIBOR would no longer be an appropriate benchmark interest rate for taxable debt. which is important for determining hedge effectiveness using the consistent critical terms method. That provision was effective for December 31st, 2021, which was when LIBOR was supposed to sunset. However, the FCA, the Financial Conduct Authority in the UK, who became the authority over LIBOR, decided to extend the sunset date for certain US dollar LIBOR tenors because of the difficulty in the transition. And so the 1 week and 2 month LIBOR tenors did sunset when they were supposed to. The other tenors will now sunset in June of 2023. But then we also became aware that even after that date, they may not just get rid of LIBOR, they may just start publishing what they call a synthetic LIBOR. And so one of the changes in the Omnibus is to first change the effective date of when LIBOR would no longer be an appropriate benchmark interest rate for taxable debt. But instead of applying a specific date for when that would be effective, the Omnibus says that it's no longer an appropriate benchmark interest rate when the LIBOR administrator no longer publishes it using its current methodology. And that is a methodology where they use responses from a panel of banks. So if you have derivative instruments that reference LIBOR, that's an important provision to know about. All right, we're going to go to our third polling question, which is which topic has the largest impact on you from the Omnibus? And it's a resounding leases, P3s, and SPIDAs. So that is good feedback. We do have some with financial guarantees, and I apologize. I thought that I had closed my Teams. And looks like other also received some votes, followed by derivative instruments. We'll wait just a couple more minutes for that poll to mature. All right, we will go ahead and end it. So the effective date of the Omnibus is, well, there's several effective dates, but for leases, P3s, and SPIDAs, it'll be effective this next year. We really wanted the leases to be effective when leases were effective, but that wasn't going to give anybody enough time. But P3s and SPIDAs, those amendments are effective at the same time as Statements 94 and 96. And then the financial guarantees and other derivative instrument provisions will be effective in 2023, and everything else effective immediately. All right, so prior to we're going to move on to Statement 100. Prior to the issuance of Statement 100, the guidance for prior period adjustments, accounting changes, and error corrections was provided in Statement 62. The provisions in 62 were based on private sector guidance from the 70s, and specifically Accounting Principles Opinion number 20 and FASB Statement number 16. And that guidance was largely unchanged when it was incorporated into the GASB literature. Because of the source and age of the guidance, the board undertook a pre-agenda research activity to understand the effectiveness of the guidance. The research revealed issues regarding the understandability and application of the guidance, including issues related to the classification of transactions among categories of accounting changes and error corrections. And there was also a diversity in practice regarding the disclosures of such transactions. So the pre-agenda research also extended to users to find out what it is that they find valuable about when that information is disclosed. So the board, after all, only wants essential information, but they want all essential information disclosed. And so this was an attempt to fix the issues with the prior guidance. So I don't think it's worth our time to compare and contrast the old guidance with the new guidance. A lot of it is going to sound very familiar. It's possible that as we go through the new guidance, that it will match exactly your understanding of the old guidance. In that case, just consider this guidance to be a refresh or a re-emphasis on what you already know. Under the new guidance, there are 3 different categories of accounting changes. Changes in accounting principle, changes in accounting estimate, and change to or within a financial reporting entity. A change in accounting principle refers to a change from one generally accepted accounting principle to another generally accepted accounting principle. That change, of course, needs to be justifiable. A change in accounting principle also includes the implementation of a new pronouncements. So one difference that you might notice going forward is that because this pronouncement provides for how to account and report for the implementation of new pronouncements, future pronouncements will not be explicit about implementation. Rather, future pronouncements will simply refer to the guidance in Statement 100 unless the board decides to prescribe something different. So you may have noticed that when you opened up Statement 101 and started reading it, that the implementation section there just references to Statement 100. The guidance also provides a definition of an estimate, which is an amount with measurement uncertainty. There are 2 components to an estimate. There's the inputs, and then there's the measurement methodology. Although those are the 2 parts of an estimate, when we talk about accounting and financial reporting for a change in accounting estimate, we're really talking about changes to the inputs. And those changes need to result from a change in circumstance, new information, or more experience, because otherwise we're in correction of an error territory. The change in measurement methodology, although it affects estimates, it's more of a change in accounting principle, and so you would follow that guidance instead. And then the third category, you might notice a change from the old guidance. The old guidance refers to a change in the reporting entity, whereas here we're talking about a change to or within the financial reporting entity. And that wording change implies a little bit more. It includes the addition of or removal of a fund, the change of fund presentation, say from major to non-major, the addition or removal of component units, or a change in the component unit presentation. This does not include anything within the scope of government combinations or disposals, guidance in Statement 69, or the majority equity interest guidance in Statement 90. So I'd mentioned earlier that a change in accounting principle must be justifiable. The old guidance talks about justifying the change on the basis that it is preferable. The new guidance is a bit more explicit, requiring that the change be justified on the basis of that it is preferable in terms of the qualitative characteristics of financial reporting, which are described in detail in Concept Statement 1. I would note here that one of the qualitative characteristics is consistency. So by the very nature of changing an accounting principle, you are negatively affecting consistency. So the argument regarding the other characteristics must be that much stronger to compensate for that. Also note that a change in accounting principle due to the implementation of a new guidance does not require the same justification. When the board proposes new guidance, they are already taking into account these qualitative characteristics. And then, as I said, there are 3 different categories, which is important because there are 3 different ways to account for the changes. So changes in accounting principle including the implementation of a new pronouncement or changing the measurement methodology of an estimate are reported retroactively by restating the beginning net position or fund balance for the earliest period presented. For changes in accounting estimates, you would recognize the change prospectively in the current period flow. And then for a change to or within the financial reporting entity, you would be reporting the change as if it occurred on the first day of the reporting period. I don't think we set the world on fire with these changes. I think that these may sound familiar, and they make a lot of sense with regard to what the nature of the change and how it should be reflected. I believe that when the pre-agenda research revealed a diversity in practice, the disclosures was one of the key areas of diversity. So one of the things that I noticed about the guidance is that it is more explicit about what to disclose, trying to arrive at this level of detail that provides all and only essential information. Note that this slide summarizes the requirements for accounting changes, but there is another slide at the end that will reflect disclosure requirements to be applied, whether it's an accounting change or a correction of an error. So this is not all of them. We'll get to the ones that apply universally in a second. This statement also provides guidance about how to reflect these changes in RSI and SI. As you know, some RSI and SI are designed to reflect trends and provide historical data. The MD&A will typically present at least 1 year previous to the years presented in the financial statements. And some of the RSI schedules reflect a 10-year trend. So the board decided that the burden of restating all years in RSI and SI would not justify the perceived benefit to users. So the requirement is to restate the periods in RSI and SI that are also reflected in the basic financial statements, but you would not restate earlier periods. If the change creates a consistency issue, then you would add a note disclosure explaining the cause of the inconsistency. And then in the MD&A, you would also refer to the note disclosure explaining the change in accounting principle. This obviously would not affect changes in estimates because those are reflected prospectively and would not affect prior periods. So let's talk briefly about error corrections. The new guidance provides a definition, which isn't all that different than how an error correction is described in the old guidance. An error is a mathematical mistake, a mistake in the application of an accounting principle, or oversight or misuse of facts that existed at the time the financial statements were issued. And if you're not aware of the facts, then the assessment becomes, should you have been, or could you have reasonably obtained that information in order to determine if it was an error. Note that statement 100 does not apply to those entities who are adopting GAAP for the very first time. Some governments may have adopted GAAP with the exception of one principle. And if that government later adopts that principle, that would be a correction of an error rather than the first time adoption of GAAP. So how do you account for and report an error correction? And error corrections are accounted for in a similar manner to changes in accounting principle, which is retroactively by restating the beginning net position or fund balance of the earliest period presented. In the note disclosures, you would describe the nature of the error and its corrections. And then one difference here is that the guidance requires that all affected information be corrected, including in the RSI trend information. There's just something about knowingly including misstated information that has not been corrected that the board doesn't like. So the board was convinced, however, to include this practicability exception, which was not in the exposure draft, but you need to know that practicability is a pretty high hurdle. It does not mean the same as practical. It means impossible. So unless it's impossible, then your RSI and SI should be reflecting the correct information. And then this is the slide I alluded to with regard to other reporting requirements for both accounting changes and error corrections. And this will go a long way to resolve some of the diversity in practice. The guidance requires that on the face of the statements that an aggregate amount of adjustments to beginning net position be displayed. And then in the notes, you would have a table. It requires a table to highlight the effect of each change or correction. And note that should be at the reporting unit level. And that statement is effective for fiscal years beginning after June 15, 2023. So you've got some time to think about that. And then we've got just 5 minutes left, and I apologize that I'm running out of time, but we will cover statement 101 as quickly as I can. This statement resulted from a re-examination of statement 16, which was issued 30 years ago. And during the reexamination, several issues with Statement 16 were identified. And some of the issues identified included the lack of guidance for certain types of leave. And then there was also some inconsistent application of Statement 16, and as well as some inconsistencies with the GASB conceptual framework, which was developed after the issuance of Statement 16. So if you think back over the last 30 years, it has become more important to attract employees through employee benefits. And so there has been some evolution with regard to the types of leave that exist and are offered to employees. Statement 16 addresses vacation, sick, and sabbatical leave. It identifies different characteristics for vacation than for sick. And so the guidance takes you down two different paths based on those characteristics. Statement 101 is a bit different in that it takes a principle-based approach. It defines compensated absences and then provides recognition principles to be applied to all types of leave. So a compensated absence is defined as leave for which employees may receive cash, payments when leave is used for time off, other payments such as a payment for unused leave upon termination, or non-cash settlements such as conversion to defined benefit plans. So examples would include vacation, sick, paid time off, holiday leave, parental leave, military leave, bereavement leave, and certain types of sabbatical leave. And we'll go to our last polling question now. Which type of leave is most common for your organization? We've got the vacation and sick, we've got the PTO. I'm curious if anybody has unlimited leave. I've heard some firms offer that now, and if anybody has any other types of leave. And it looks like vacation and sick is still the predominant leave for this audience, with PTO being at about 23%. There are a few with unlimited leave, and then a few with other types of leave. Just give it a few more seconds for this poll to mature. I will say I've heard that those with unlimited leave end up taking less leave. That I don't know if that's true for those who have that. All right, just a few more seconds. Looks like we've settled 75% on vacation and sick and 23% on PTO. All right, well, just a quick note here, the compensated absences guidance does not apply to certain types of sabbatical leave where the employee is required to perform duties of a different nature. So just if you get switched to a different job, some organizations still call that sabbatical because it's temporary assignment from your normal duties. That's not included here, as well as all of the arrangements under Statement 47 for termination benefits. And so this will probably be the last slide I'll have time to talk about, maybe this one, the next one. There are 3 recognition criteria with this new guidance. The leave must be attributable to services rendered. The leave must accumulate, and then it must be more likely than not to be used or paid. You'll see that threshold again, more likely than not, and being used here. Note that vesting is not a recognition criteria. Some governments offer sick leave that vests over time or doesn't vest at all. The non-vesting portion of the sick leave would not be paid out at termination. Statement 16, in Statement 16 has affected the amount of the compensated absence liability, but the board decided that vesting should not be a recognition criteria. If the leave can be carried forward to a future reporting period, it would represent a present obligation, regardless of whether or not it eventually got paid out at termination. So whether or not it's actually paid out would be considered in the probability assessment, which is the 3rd recognition criteria. With regard to the probability assessment, note the threshold here of more likely than not, which has become the favorite threshold of the board. Statement 16 uses the threshold of probable, which the board feared would be viewed as a high threshold, resulting in an understatement of the liability. And then just briefly, the exception to the recognition rule, leave that can be converted to defined benefit post-employment benefits are scoped out. The board had no intention of unwinding some of the provisions of statement 6875, which would already include those liabilities in the actuarial liability. Believe that is dependent on a sporadic event, and only for a small portion of employees would also be excluded, such as parental leave. You would recognize that leave when that leave commences. And then unlimited leave and holiday leave, you would not recognize until it is used. Now, I am all out of time, and so I'm just going to stop there and just switch to the end with my contact information. And I think a few of you did ask some questions, and I apologize. Those actually were not right in my view, and I see them now. But we will be sure to get with you later and address those questions with you.
Thank you so much, Scott. We really appreciate it. Thank you all for being on our first session today. We do have another session coming up in about 15 to 20 minutes. So we look forward to you joining our next one in our series. As Scott mentioned, if you do have questions, his contact information is on the slide in front of you. Feel free to reach out. And a reminder, we do have a survey that will be posted as soon as this session ends, and we will see you all soon.